I've given you an Excel file. Download it. Can you see this? PPT?
Yes, ma'am.
Okay, now you see, given the data of the yearly return of HUL, Hindustan United Liver, calculate the ARR on investment register over a 10 years period. Mute yourself. Okay. So you have to calculate the rate of return over a 10 years period. Go to the thing and calculate and tell me. Can you see the board?
Yes, ma'am.
Okay. So let's go for this calculation. So your average rate of return, what you have seen just now by the definition, your average rate of return is what is known as the arithmetic average. Okay. It is simply the arithmetic average of the investment where your ARR formula is given as R1, the return from the various years. Say R2, you have n number of returns, whole divided by the number of years you will do. So it is simply your summation of the returns of the various years where t is changing from 1 to n. Okay. So where your R is, this is shown as R dash or ARR, average rate of return. Okay. This is your average rate of return. If these are your return over different years on an average, how much did you get? And RT are the observed return values. Observed rate of returns over the different period. Okay. So over 1 to n number of years. This is your number of periods. Okay. Why I write period? Because it can be other than year also. You can have your monthly, daily also. Your stock market shows hourly, daily return variation also. So it is simply you take the return divided by the number of interest period or return period, which is your average rate of return. Now I have give you a file. Did you all open that? The first one, session 1.
Yes, ma'am.
So I'm also sharing it here. So did you get the average rate of return? Are you able to see the Excel file?
Yes, ma'am.
Okay.
No, ma'am. It is still showing the board.
Okay. So now?
No, ma'am. We can still only see the board.
For a new share.
Now we can see the Excel file.
Excel file. Okay. So now you see, this is the file you got. Okay. So simply you are going to calculate what is the rate of return. That means you have to calculate this column 6. What is the rate of return? Is the summation of the return you will get over the day. This is, remember, this is your average rate of return. Average. Before that, you have to go get the rate of return. Rate of return you have just calculated in the previous session, which is your dividend yield plus your capital gain or losses. You have to take the summation, which will give you the return over the various years. After getting the return of the various years, then you are going to take the summation of this average return, which will be your average rate of return. So what you go are doing is first find the dividend yield, then go and calculate the this share prices, capital gain or loss. After that, you calculate, take the summation. Go on starting with the number 1, 2000, year 2000. Tell me what is the dividend yield. I've written the formula so that you remember also. Your dividend yield is simply your dividend divided by the share price of the previous year. So it is PT minus 1. So your dividend yield is dividend of that year divided by your share price of the previous year. So you have to leave the first one blank because previous year, for example, year 2000, you don't have a previous year share price. So you have to start with, I've given you a blank there, you can see. So there is a blank here. So you have to start from here, 2001. What is the dividend yield in the first year? Tell me. How much is the dividend yield in the first year? Doing?
Yes, ma'am.
How much is it? Dividend is how much given? 5? Okay. So how much is given? 5 divided by what is the share price of the previous year? 206.35. Isn't it? Simply you have to select, enter. See, this is your answer. Did you get?
Yes, ma'am.
You just put a bracket there, and multiply with 100 so that you are able to get directly in terms of your percentage. So change that into a percentage. So I again repeat, it is simply your dividend for that year divided by share price of the previous year. If I keep, you can see the formula. Into, you just multiply with 100. You got it. Amartya, did you get? Amartya, did you get? Nikhil, tell me the same for the second year.
Just a minute.
Similarly, dividend divided by share price of the previous year.
Ma'am, 0.02459. 0.02459.
0.02459 you got. Achha. 0.2459. Okay. So what we can do is, see, I'm again doing. So I just click on the dividend. You're doing in Excel, it is very easy. So divided by, I take the share price of the previous year. Okay. I just put a bracket here and then multiply with 100. I get the answer. This is what you told. Change it into percentage.
Okay, ma'am.
Okay. Now we can also change, you can just see, click here on the first and you can reduce your number of zeros here. If you just click here, see decrease decimal. You can decrease your number of decimals here. Did you see? Just click.
Yes, ma'am.
Number of decimal is reduced. Now what you do is, instead of doing like this, what I can do is I just simply drag. See, all are done. You got answer for all.
Yes, ma'am.
But are the answers correct? Let us check. 3 point some mistake, I think. So this is 5 4. This is 5D54. No, there's a mistake there. This I think I have wrongly
Ma'am,
done.
it should come 0.2459.
This is formula has not been copied properly. This is correct one. So after that, if I complete this, still not coming. So we have to do individually or what? Formula is not getting copied. Did you try?
Yes, ma'am. I got the answer. I mean, required numbers.
You are able to copy the formula?
Yes, ma'am.
My invite is coming, not coming. Let me check. It is coming this way, but I'm copying the formula. It is not coming. Let me check again. Just, now it came, I think. These are the answers, correct?
Yes, ma'am.
Okay. So now let us go to the second one, capital gain. Capital gain or loss, you know the formula. Formula is what? Your share price in the current year minus share price in the previous year. Put that into a bracket. Put that into a bracket. Whole divided by your share price of the previous year is what you get as your this one. Okay. So just to change it to percentage, we'll put the whole into multiply with 100. So what we do is multiply with 100. No, it's not coming. So we have to, after doing that only, I think we have to.
Ma'am, use parentheses only. Don't use that square brackets. I think that will help.
Yeah, tell me what?
Use only parentheses. I mean, only normal brackets.
Only as a
Don't use
normal bracket.
square.
Okay. Yeah, that's the one. So let us drag it. It is completed. Did you get the answers? These answers?
Yes, ma'am.
Okay, let us reduce the number of decimals and then again drag it. Okay. So now what is your, now we are going to calculate this rate of return. Rate of return, you know what it is. Simply your summation of column dividend yield plus your capital gain or loss. Okay. So this is simply equal to, this will be simply equal to your dividend yield here plus your capital gain or loss here, enter. This is what you got. Simply drag. Got these answers? Did you get these answers?
Yes, ma'am.
Okay. Now you know how to calculate the average rate of return. Calculate your average rate of return, which is simply the average. What you can do is simply, you can see here there is a function here. You can choose the average function here. Average. Did you get? From the function here, you can simply choose the average function here. Then what you can do is simply drag it. Drag the number of variables. It will give you your answer directly. It will directly give you your answer. Here let us put a 0 here and then take the average function. What is your average? Did you get? How much average did you get?
Average is 10.48.
10.48. You got the average. This is for how many years? Ten 10.48 you are getting?
Yes, ma'am.
48 or 28?
48, ma'am. I'll do it again. One. Just.
This is the answer. So some decimal difference may be there, but why it is coming decimal difference? If these are your exact figures, why should you get a decimal difference? You have taken 0 for the first year or not?
Yes, ma'am.
You take a 0 for the first year because in that case, all the years will get included. So I think how many places of decimals you have rounded up, that is also mattering.
Yes, ma'am. I'll do it once again.
Just drag. You are doing individually or just dragging like this?
Ma'am, I just drag. I will enter individually and try once again.
So you'll check it out, okay, Nikhil?
Ma'am, your and mine 2011's value of dividend yield is coming different. That is
Which
why I'm
one?
getting a different.
2011.
2011's. Yes, ma'am. 2011's. Yes, ma'am.
Why? What is your
I got,
answer?
ma'am, I got 2.72. Yours is 2.09.
11th year. 11th year, 2.09.
Yes, ma'am.
Ah. 3.5474. This is 2.09. Actually, yours answer is
2.72. Sorry, 2.72 it is.
only for that year. Why there is a difference? I also am not getting. This is see why it is taking 5. See here in the formula when I'm clicking, it is taking 5.
Yes.
But why for? All are same. they are showing
Then
the
it is.
some places it is doing like this. See, this is also in the
Yes, ma'am.
seventh year also. It is also doing the
It is
same. It is something different. Why it is now? Rather to do wherever.
Yes, ma'am. Seventh year also the value is different.
Yes, why it is doing that thing, I don't know. So what I'll do
In
is,
calculator, if I'm calculating for 11th year, it is 2.72. 6.5 divided by 238.7.
again in this ninth year. After every 3 tests, it is repeating the thing. Now answer has matched, see?
Yes, ma'am.
Answer has matched. Okay, now let us proceed. Can you see the PPT?
Yes, ma'am.
Okay, so let us proceed here a little further. So this is what you have already calculated, the average rate of return. And for this company, you have calculated the average rate of return. And this will have rampant use further. Okay. So now going to your holding period. Suppose you are not selling the share at the end of the particular year. In that case, your rate of return will be different. That will depend upon your holding period, how many years more you are holding that. Okay. For example, here say the investor is holding the share for a longer than 1 year. Then how you are going to calculate the holding period return? Here, for example, suppose you invested rupees 1 today in a company share for 5 years. Rate of return every year. Rate of return means just now you calculated. This is your rate of return. Every year, you calculated the rate of return. Suppose your rate of return is 18%, 9%, 0%, minus 10, 14. These are for 5 years. Okay. So what we have to do is, we'll calculate what is the worth of your holding period. So the worth of your investment after 5 years, assuming each year's return is this, simply your 1 rupees compounded for 18%. Similarly, second year for 9%, 0%. Then there is a negative return in the fourth year, 10%, and this. And so if you see, your 1 rupees have grown to 1.32. So there is a 32% jump in your investment. Each year return, you know all to calculate. In this question, they have given you the calculated return. Simply, your 1 rupee is your investment. Whatever your investment multiplied with your percentage is the return every year. So for 5 years, your return is 1.32, which is your 32%. Did you understand?
Yes, ma'am.
So in this case, what is the annual compound rate of return? If this is for 5 years, for 5 years, you have calculated 1.32. So annually, how much did you get? That is what we are going to calculate. So that is given by the geometric mean return. And the geometric mean return will be the nth root of your return every year. Your return is 1.18, 1.09, 1, because third year you don't have any return. Then 90, 10% decline. Then 14% minus 1. So this is what is known as the geometric mean return. If you are given the return over the your after 5 years, 10 years, you are given. If you want to find annually how much did I get, if you want to calculate that, then this is the annual compound rate of your return. This is the rate at which your return increased over the years. So it implies in a reverse way that if you invest rupee 1 today at 5.7%, then your annual growth rate, you can see, you just take the reverse. At 5, fifth root of this is 1.32 after 5 years. So if you want the annual growth rate, you have to take the geometric mean, where your geometric mean is the nth root of your total return every year. If you have done, let me know.
Done, ma'am.
Done. Okay. So now we'll proceed to calculate the risk and return. See the risk and return. Now, when you are, what you calculated is the rate of return. Now, along with return, there are much risk involved with your share, depending upon what type of share you are purchasing. For example, your treasury bill will be safer than your equity. Treasury bill are the bill which you invest on your government bonds, so which are very much secure. But if you are investing in an equity, you have a lot of risk involved. So you want to calculate the risk and return on your investment. For this, the terms we use are, we calculate the variance and standard deviation. Okay. So the rate of return for this calculation you made just now for the HUL company. Okay. You saw that there is a wide fluctuation. If you see, see, somewhere the return is so high. For example, 2010 you got 10.8, and somewhere it is fluctuating minus 16 return. More in 2013 there was a drop by 27%. 2020 there is an increase by 46.6%. So this is showing wide fluctuation in the return. You cannot just predict what your return will be next year, because this company is showing a wide fluctuation in the return over the years. It is not stable. Okay, it is not a stable return. So you want to calculate how much is the volatility, what is the change, fluctuation risk you are involved. In that case, what we do is we calculate the change in the volatility, and this volatility is calculated by two concepts, what is known as the variance and the standard deviation. Okay, so right from here, risk to return measurement. So the variability, you just write here, the variability in the return is measured in terms of deviation of returns from the average rate of return. And this is measured in terms of your variance and the standard deviation. How much your return is fluctuating from your average rate of return. For example, in that we calculated the average rate of return, isn't it, just now? How much it is? 10.49?
10.49.
Isn't it? So if you take the deviation, for example, for 2001, your return is 10.81. How much it has deviated from your average, 10.49. Similarly, 16% negative. How much is the deviation from your average rate of return, 10.49. So in order to find how much is the fluctuation volatility, what we do is we take the difference of the return each year from the average rate of return. First, you have to calculate the average rate of return, and then you have to go for a calculation of the deviation of each return from it. Okay. So we go back to the PPT. Can you see the PPT now?
Yes, ma'am.
Okay. So we are going to calculate this volatility with these two concepts, which is known as the variance and the standard deviation. How to calculate the variance? Okay, the steps, write the steps, because you are going to calculate it now. So what are the steps for calculation of this variance? First is you will calculate the average rate of return. You know how to do. Simply calculate the ARR, which you have just done now. Okay, after calculating, you take the deviation of the return of every year from the ARR. Every year, for example, in the 2001, it is 10 point something, I think 10.8 something, minus your average rate of return, which is 10.49. Second year, minus 16, minus average rate of return, which is your 10.49. Go on taking the deviation of the returns every year from the average rate of return. Write the steps. Number one, calculate the average rate of return. Rather, let me write on the board so that you follow or know how to write it. Can you see the board? Are you able to see the board? Can you see, Nikhil? Amartya,
Blank screen only.
you can see the board?
Yes, ma'am.
Okay, so let us calculate the risk, which is your calculation of the variance. Okay, so calculate steps to calculate variance.
Ma'am,
Yes.
ma'am, I got logged out for a few minutes, like 1 minute.
Yes, yes, I was calling you Nikhil. So I'm writing here. Can you see the board?
Yes, ma'am, I can see it now. Thank you.
Okay, right. Calculate steps to calculate the variance. Calculate the variance. Remember, we calculate the variance to find how much risk is involved in your investment. So first, to calculate the variance steps is number one, calculate the ARR. So calculate the average rate of return. Calculate the average rate of return. Okay. Or this is shown by R constant. So where your ARR is given as, you simply already you know what to do. You calculate the returns for every year. Okay. So for n number of years, take the summation, and this is your average rate of return, which is simply your RT discounted for the summation of the RT for the various years, where T is changing from 1 to n. T changes from 1 to n. Okay. Next is, after calculating T, simply take the deviation. Calculate the deviation. Calculate the deviation from ARR of each year's return. Each year's return. You know how to calculate each year's return. Your dividend yield plus your yield from the share price, capital gain and loss. After getting the return, get the average return. After getting the average return, take the deviation from the average return. Okay. After taking the deviation from the average return, third step is square it. Square the deviations. Square the deviations. That means what you are going to do is, you are going to calculate your R minus R for every year and then square it. Then your fourth step is variance. Variance, which is measuring the risk, is given as sigma square, which is your summation of this deviation you have taken. Square of this deviation you have taken, T changing from 1 to n. That means step 3 divided by your n minus 1. Your n minus 1. Remember, for population, it is divided by n. For sample, it is n minus 1. Here you have to remember, if your sample is a population, from population, okay, so you will take, it is divided by n. Divided by n. But if you are using sample, but if sample, you divide it by n minus 1. And all our work are always with sample. That's why n minus 1. Hardly, other than the census, we cannot use the population. Okay, so now standard deviation is, how to calculate the standard deviation. Standard deviation is given as root over variance. That means root over your sigma square, because your variance is sigma square. Or this is simply your standard deviation. You can take this way also. Summation of the square deviation you have got divided by n minus 1, T changing from 1 to n is your standard deviation. Or you can simply calculate the variance and take its square root. Comes to same. Your standard deviation, which is yours given as sigma, is simply the square root of the variance. And because your variance is sigma square, its root over will be sigma. Have you done?
Yes, ma'am.
Okay. So today we are going to log out here. Remember what we calculated just now is the risk and volatility involved. A share which is having higher standard deviation or your variance will have is more volatile. Next class I've given you a hand session on 5 different type of your asset. One is a your treasury bill, another is a bond, another is a bank investment. So we'll calculate how much is the risk involved in each using this formula, and from there we'll continue. So what you have done today is calculating the risk and return of a single asset. Okay. And gradually we are building up the portfolio. Portfolio means when you don't put your money in a single investment. That is not wise. What you do is you diversify. You put your money in different investment. Next class we are going to calculate for different assets how is the risk and return calculated, and then for your overall portfolio we'll calculate it. Okay. So we'll stop the
Uh,
session here. Yes.
Ma'am, what is the syllabus for the medicine?